last chapter. Here we go. So we're not going to talk about taxes anymore. Yay, you can celebrate. Not having to do that anymore, but now we're going to talk about accounting. Okay, so again, show of hands, who has taken either Intro to Accounting, Fundamentals of Bookkeeping, or Principles, or are currently taking one of those classes. So show of hands. So, all right, so it looks like I've only got maybe one that hasn't. Okay, well that's good. So you guys are all experts on debits and credits, right? You all know how that works? So I don't have to go into a whole lot of detail, but we'll do some review for you. Because that's what we're going to talk about in this class. So we've got all of this information that we have compiled through paying employees. We've got wages that we've paid, we've got payroll taxes that we've paid, we've got unemployment taxes that we've paid, all of these different payments that have been made. We also maybe have some amounts that are due at some point in the future, because remember, our payroll taxes aren't due at the time that we pay the employees. They're going to be due at some point in the future. Maybe that's the next day, maybe it's the next Friday or Wednesday if we're a semi-weekly depositor. Maybe it's the middle of next month if we're a monthly depositor. Maybe it's at the end of the quarter if we're a quarterly depositor. But at some point in the future, we're going to have to make those payments. So in the meantime, we have to record those expenses on the financial statements. We also have to record all of the wages that we've paid and any other amounts that are related to payroll. Now, payroll is, by and large, the largest expense of most companies, the single largest. And so it is vital that that information be recorded accurately and in full on the financial statements. Now, the payroll department isn't the department that is going to be making the actual journal entries into the financial accounting system, unless, of course, it's a smaller company, in which case it very well may be that whoever is in charge of payroll is also going to be fulfilling some accounting functions, right? But generally speaking, for mid to large size companies, it's going to be the accounting department that makes those journal entries and make sure that the financial statements are accurate, but they have to work very closely with payroll in order to get that information. So that's what this chapter is about, is integrating then all of those transactions that we have studied over the course of the semester, all of the financial transactions, how does that fit into the financial statements? Okay, so that is what we're going to be looking at starting today. It's great that most of you are already familiar with debits and credits. I will do just kind of a little quick overview, just a reminder of how all that works. And maybe some of you in your classes, I know there's a payroll, I think there's a payroll section in a couple of those classes. And so you may already be familiar with some of the journal entries that we're going to look at here. So that is awesome. That means that this will be really super easy for you if you're already familiar with that stuff. So remember, we have a payroll cycle and we have an accounting cycle. So with the payroll cycle, what we're looking at is producing the steps in producing those paychecks, as well as paying all of the taxes that are then due, making those payments to employees. With the accounting cycle, oftentimes the accounting cycle and the payroll cycle can be different, right? Payroll cycle, remember, we might have a weekly payroll cycle, we might have a bi-weekly, semi-monthly, monthly, depending upon how frequently our employees are paid. And recall as well, we may have multiple payroll cycles within our company as well. We may have some employees that are paid on a monthly basis while others are paid on a weekly basis. The accounting cycle oftentimes runs just on a calendar month, calendar quarter, and then on an annual basis as well. So one of the complexities is making sure that the financial statements and that accounting cycle accurately reflects the payroll cycle. So sometimes, and you'll see when we get into these, sometimes when they don't overlap neatly, or when they don't end at the same time, then we've got some little bit more complex journal entries that we have to make in order to accrue any of our liabilities, and accurately record what our expenses are during that period. So, with regard to how all of this fits into the accounting cycle, in this order, this is the order in which we would record transactions. So, the first place, and you remember the payroll register and employee earnings records, remember that we talked about those early on in the semester. We're going to be looking at those again. First place we would enter information is in that payroll register. Do you recall what the payroll register is? What type of information is contained in the payroll register?
Information on each employee.
So information on,
A list of
yes, on all employees for one pay period, right? So it's going to be a summary of everybody, all of the information for all of the employees that were paid during that pay period. We are also going to be extracting information from the employee earnings record, which again pertains to each individual employee, right? We extract the information from those records and we enter it into what's called the general journal. Does anybody recall what the general journal is? It's easy to get that one confused with the general ledger, because we have the word general in both of them. Do you remember what the general journal is?
where you do all your transactions.
Yeah, all of your journal,
entries.
yes, all of your journal entries. So you can use that to kind of remind yourself that of what general journal is. The word journal is in there. So it's all the journal entries, and it is on a chronological basis. So it doesn't matter if it's a payroll transaction or we're purchasing some supplies or some other transaction that has occurred during the month. We're paying some vendors. It's all entered in regardless of what the expense is or the accounts that are credited or debited. It's done on a chronological order. In a chronological order. So it's got all of those transactions in there. Well, that's awfully difficult to understand if you're just looking at a general journal and trying to discern how much has been spent in a particular category, expense category, like how much did we pay in wages during the month. If you were just to look at the general journal, you really couldn't tell. You'd have to do some math on the side, because then you'd have to go through and add up all of the expense for wages and pick and find out all of the transactions that affected wages during the month. So after entries are made into the general journal, they are then posted to the general ledger. Does anybody recall what the general ledger does?
Keeps all the accounts that we control.
Right, that's our T accounts, right? So we make our journal entries first, and then we transfer all of that, which the journal entry is made in the general journal, and then all of those separate accounts that we have used for making those journal entries, we transfer all of the information to the general ledger and each expense category, each asset account, each liability account has their own listing of what transactions transpired in there. And from that, we can get the summary of how much our expenses have been for the entire period. So all of our wages expense, or all of our payroll tax expense, all of the health insurance expense that we've had, as well as we can get a summary of how much we owe with regard to liabilities. Some liabilities, so the payroll tax liabilities, health insurance liabilities, anything that we owe to somebody else. So then it gets posted to the general ledger. From that goes to trial balance. All of that information gets consolidated into a listing of all of the accounts on the trial balance. And then from that trial balance, some adjustments are made at the end of the month, adjustments usually for like non-cash type items. So depreciation, that sort of thing. Anything else that maybe needs to be adjusted at the end of the period that wasn't correctly entered in the first place. And then we get our adjusted trial balance, and from that adjusted trial balance, we make the financial statements. So essentially what we're doing here is we're just transferring information from one place to another, making the summary of that information more clear with each step. Okay, so when we're talking about payroll, there's certain information that we're going to be using, certain expense accounts that we're going to be using. Like, we're not going to be using supplies expense, right? We're not going to be using depreciation expense or a lot of asset accounts. We are going to be using cash as an asset account, but for our purposes, we are mainly going to be using, so our expense accounts would consist of wages or salaries, expense, payroll tax, expense, really those are pretty much the main ones that we would be using for payroll. There are other accounts like health insurance, where if it's the employer that is paying their portion of the health insurance, it's not really going to be pertaining to payroll itself. That's going to come from the accounting department. Asset accounts that we will use, pretty much just cash, right? Whenever we make a payment. And then we've got some liability accounts that we're also going to use. And remember, a liability account means that this is some amount that we are going to owe somebody else in the future. We have accrued an amount that is due at some point in the future. So we may have payroll tax liabilities, and you'll see liability. How many I's do I have in there? I guess it's not right. I lost my train of thought. No. So payroll tax liabilities. We may also have some salaries and wage liabilities if we're accruing some salaries and wages at the end of a period that we haven't paid yet. And some various other accounts, but those are the main ones that we're going to be looking at. All right, so there are 4 main journal entries that we make when we are recording our payroll information in the financial system. The first 2 occur when payroll happens, and that is the trigger. We pay employees, and therefore these 2 journal entries have to be made. We are going to journalize our payroll, gross payroll, and the amounts that were withheld, and we'll go through these journal entries together. And then we're going to journalize the payroll taxes that the employer has, and any workers' compensation insurance expense. There may be, and payroll taxes included in that would be FUTA, SUTA, Social Security, and Medicare taxes. So those two journal entries happen at the same time, and the trigger is we have paid an employee, at least one employee. Maybe we've paid all of them, right? But anytime we make a payment to an employee, we're going to make those 2 journal entries. Now it could be a special payroll that we've run if we have an employee that we have terminated and we're required by law to pay them within a certain period of time, and depending upon the state that we're in. Remember, Iowa, there is no requirement to pay an employee that's been terminated any sooner than the next regular payroll. But there are some states where if an employee is terminated, maybe they have to receive that last paycheck on that last day. Or maybe they have to receive it within a couple of days. If that's the case, then we may have an entry here for just one employee. But because the employee has been paid, that triggers the need for a journal entry. Okay? The next journal entry, the trigger for this is when we pay our payroll taxes. When we make those payments to the IRS or to the state, and remember, that's going to, as far as our payments to the IRS, that's going to depend on how much we owe. We've got those different those different requirements. We've got the monthly requirement, or the semi-weekly requirement, or the next day requirement, depending upon how much we owe. When that payment happens, we're going to make this third journal entry. So in all three of these first three journal entries, some sort of transaction has occurred that triggers the need for those journal entries, right? We've made some sort of payment. The last journal entry, however, is not triggered by a payment. It's triggered by the calendar. We're at the end of an accounting cycle, and we need to make some adjusting entries at that point, okay, in order to accurately reflect what our expenses and our liabilities and our income and all of that is for that particular period. Okay, so let's take a look here. Questions so far? Is all of this ringing a bell? Is it kind of, oh yeah, okay, good. Let's see. So the payroll, I don't have to go through the payroll register. You guys should know what the payroll register is by now. So each time there's a payroll, or even if it's just one employee, again, that's being paid, that payroll register is going to be run, right? Employee earnings record, again, this is on a per employee basis. The employee earnings record is used, and we use the employee earnings record not just in helping us to make these accounting entries, and it works together with the payroll register when we do that, but we use it also for putting together W-2s at the end of the year, because remember, this is a cumulative account of everything that employee has earned, all of their wages, all of their taxes, the withholdings that have been made as well, and that information then is needed to transfer to the W-2s. All right. So let's take, it's actually probably, well, maybe not. Okay, so some other amounts that, in this section we're going to talk a little bit more about some of the accounts that we're going to use. So gross payroll, that's the total amount that we are paying. That is going to be part of our initial journal entry that is made, and that is, let me back up a minute. Does everybody remember the debits and credits? Remember what debits and credits means? If you're all in accounting, financial accounting right now, then you should be pretty set on remembering what debits and credits means, but we'll do just a little bit of a review in case it's been a while. Does anybody remember what debit means? What's debit mean?
It was on the left.
Left, exactly. That's all it means, is left. What's credit mean?
Everything to the right.
Right. Exactly. Unlike our bank accounts, if you look at your bank statement every month, you'll see debits and credits, right? Those are different from these debits and credits. For the bank statement, a debit means you've had some sort of expense go out. Money has gone out. Credit means money has come in, but that's not what this means for accounting. Debit simply means left and right. And this has to do with the journal entries that we're going to make. We have certain accounts that have normal debit balances and certain accounts that have normal credit balances. And the beauty of accounting is that all of our debits are going to equal all of our credits all the time. If they don't, something's wrong. This is why we as accountants love to have everything balanced. right? And it bugs us when things don't balance, because this is how our brains work. So recall, we've got, so debit is on the left. That means for our journal entry, we're gonna have, and I'll just make up some accounts here. So wages, expense, and cash. These two numbers have to balance. With every journal entry that we make, they are going to balance. So there are certain accounts that have a normal debit balance. Does anybody remember what those types of accounts are? And I'm not talking about like specific names for these accounts, but remember think of the balance sheet. We've got assets, we've got assets, liabilities, and equity, right? There are lots of different accounts within those categories that we use. So debits, well, I should say normal balance. For debits, anybody remember what those accounts are? Assets. So any asset account. And when we say a normal balance, that means that it's a debit balance when we increase the amount in that account. Right? What other types of accounts? Expenses. There's one other category of accounts. Dividends. How do you remember that, Steve? AED. Right. Some people. AED. I know that if you've taken a class with Lisa Lockhart, she refers to it as AE Dairy, Anderson Erickson Dairy, as a way to remember those three accounts. So for the credit accounts, it's everything else, right? Everything else has a normal credit balance. So that would mean our liabilities, our equity accounts, I have enough circles in there. Every other account is going to have a normal credit balance. So for payroll accounting, the expense accounts that we're gonna look at are wages expense, payroll tax expense, might be workers' compensation expense, that sort of thing. The asset accounts that we're gonna use, really there's only one, it's cash. Okay? It's cash that's gonna come out. We don't talk about dividends in payroll. We're not gonna worry about the dividends, so just the assets and the expenses. We're also not gonna worry about equity for payroll. But we are going to talk about liability accounts. These are amounts that we owe to somebody else in the future. So those are the main accounts that we're gonna look at. Now, as far as naming those accounts, each company is going to do it differently, right? So I listed up here earlier wages and salaries expense. Oftentimes, what companies will do, especially larger companies, is they will subdivide those accounts into different departments. And that is very helpful because if you want to actually analyze the expenses in those accounts, how much are we spending on salaries for those in the research department? Then we can extract that information if we subdivide those accounts. So the more specific you can get with the accounts, the better data you can gather. However, the more specific that you get with those accounts, the more complexity you add as well to the financial statements. What else do I want to say here? And like I said, so how the book has some of these accounts named isn't necessarily how you will encounter them. It's going to be specific to the particular company. Other types of accounts So group insurance premiums, health insurance premiums, or health savings account deductions. So these are amounts that may have been withheld from the employee's paycheck, right? If the employee has purchased government bonds through their paycheck, that's a possibility. There are those that they can use it as a means of saving. Union dues, if you're in an industry that has that is part of a union. Any garnishments of wages as well. So those are amounts that are withheld from employee wages again. So that without, how do I want to say this? So those are amounts that are mandated to be withheld. So things like child support or debts that are unpaid, some sort of amount that the employee is mandated to have withheld from their wages, pension and retirement contributions as well. These are all amounts that would be withheld from an employee paycheck. They're also amounts that some of them, like health insurance, may partially be paid by the employer, but again, that part that's paid by the employer, we're not really going to worry about that from payroll. We're worried about the amounts that affect the employee's paychecks and the expenses there. All right, so this just goes through and talks a little bit about some of these withholding accounts. Group insurance, usually we're talking about life insurance here, and we talked a little bit in an earlier chapter about that group term life insurance those premiums are taxable if the benefit is over $50,000. I hope you guys remember that part, but that's kind of what we're talking about here. So group insurance, so if an employee also contributes separately to a life insurance policy, that would be an amount that is withheld. So it's going to be taken from the employee's paycheck, and at some point in the future, the employer is then going to have to transfer that payment to the insurance company. So when at the point that it is withheld from an employee's paycheck, it is a liability, right? That those funds do not belong to the company. It's an amount that the company is going to have to pay at some point in the future. So because we are in that case, we are increasing our liability at the time of payment. At the time that we pay the employee, we're increasing our liability. So that would be a credit. At the time that we actually make the payment for that liability, we would debit it because we need to decrease that liability. Okay? Health insurance, same thing. So amounts withheld from an employee's wages for health insurance are credited to a liability account because we're withholding it from the employee's pay. The company owes that money then to the health insurance company, so they have to create a liability for an amount that has to be paid in the future. So at the time that the employee is paid, that liability account is credited. At the time that the actual payment is made to the health insurance company, that liability then is going to be debited to zero it out. So we'll get to some examples here in a minute. Okay, getting ahead of myself. Government savings bonds, same thing. So if an employee is having an amount withheld that they want the employer to then send off to the Treasury Department to purchase savings bonds on their behalf, it is going to be considered a liability to the company when it's withheld. So a liability would be created until the point at which it is paid, at which time that liability is then going to be debited and zeroed out. Union dues work the same way. So amounts that employees pay toward union dues will be credited at the time that the paycheck is issued, because it's an amount that's being withheld, and then once those union dues are paid, that liability is going to be debited. Let's see. All right, so some different types of garnishments. I mentioned them earlier. We've got different types of garnishments, and they occur in a certain order, a priority order, because at times employees may have several different garnishments attached to them at the same time. In first place is federal tax levies and child support. So that comes out of a paycheck first. Next would be any bankruptcy orders. So if the employee is in bankruptcy, but they have to pay certain debts through that bankruptcy, they would be in second place. Third place would be any other creditors, student loan garnishments, and any other types of administrative garnishments. The payroll department, with regard to garnishments, normally what happens is the payroll department will get a notification from the agency that is issuing the garnishment saying that, X amount has to be withheld from this employee's paycheck, and the payroll department has to comply with that. Unfortunately, a lot of times what happens, well, maybe not a lot of times, but what can happen is that employees who are subject to garnishments will job hop. So they'll be at a job until the employer gets notification that there is a garnishment, and then they'll go and switch to another job to try and avoid that garnishment, because there's always going to be some sort of time lag between when that garnishment order, when the employee starts a new job and when the garnishment order is issued, and then when the next paycheck is. But that is something that happens, that employees will job hop, and there are certain industries where that happens more often than others. Now, the Consumer Credit Protection Act will limit the amount of wages that are subject to garnishment. So you can't take all of an employee's paycheck, right? You have to give them something to live off of. So the percentage of wages that are subject to garnishment is dependent upon the type of garnishment. So for student loan payments, they can't take as much as they can if it's a child support payment. So the maximum amount of disposable earnings that can be garnished for debt repayment is whichever is less of these two. So 25% of disposable earnings for the week, so they can't take more than 25%, or the amount by which disposable earnings exceeds 30 times the federal minimum wage rate. Okay, so we've got those two requirements. We'll go through, I think you've got some homework problems, and when we get to the end of this chapter and going through the lecture, we'll go through some of those problems to do the calculations, okay? Let's see. Child support. So remember, we've got that employers are required to report within 20 days of hire to the state that an individual has been newly hired. And that is in order to check that employee's records against any amounts that may be due for child support. So, employer can withhold a state mandated fee as well for child support for administrative costs. So they can charge the employee an amount for the administrative costs of implementing the child support garnishment. So maybe 2% of whatever the child support is, they can charge that as a fee. Let's see. Child support usually comes in first. And it comes in before, it has to be applied before any voluntary or involuntary deductions. So this takes first priority. The maximum for child support that can be withheld is between 50 and 65% of disposable income, depending on other obligations and the number of weeks that the employee is in arrears. So they can take more. The further behind somebody is on child support, the more they can take, but they can't take more than 65% of the disposable earnings of the employee. That's still a pretty big chunk, but federal tax levy. So they put, the original slide here had both child support and federal tax levy as primary, but when you've got both, child support will come first and then the federal tax levy will come second. What that means is the employee owes money on their federal taxes. So they're behind on their federal taxes, and the IRS has implemented a levy. So this would come after that so the tax levy would take effect within 3 days from the receipt of the tax levy notice with the first wage payment. So if the next wage payment is a day after you receive it, you can wait until the following wage payment for that to occur. Okay, but they got 3 days from the receipt with the first wage payment. So those are garnishments, and those are amounts again that would be withheld from employee paychecks. Pension and retirement contributions, so employees may make contributions to retirement plans or to pension plans. These are amounts separate from what the employer is contributing to these plans, but this would be another type of amount that's withheld that would be recorded then as a liability until the point at which the employer actually submits the payment to the pension, and then it would be debited at that point. So that's just kind of a rundown of some of the main types of withholding outside of taxes, outside of federal income taxes, state income taxes, Social Security, and Medicare taxes. All right. Let's see. I'm gonna get to the actual journal entries because that's way more fun. Okay, so your chapter also goes through some different ways of paying wages and salaries. Normally, a direct deposit is probably the predominant way of making those payments now, but can be paid in cash. It's a little bit inconvenient to pay somebody in cash, but it is possible to do so, or a check. That would probably be the second most common. There are a couple of other types of payments though. Some employers use these pay cards. I don't know if any of you are familiar with the pay cards where an employer will actually put the payment on like a debit card for the employee. This is, they have to give employees the choice because unfortunately some of those debit cards have a fee that's associated with them, and like a fee every month. So the employers have to give employees a choice. These are useful for those employees that don't have bank accounts, and there are actually a lot of people who don't have bank accounts, and so they can get that money on a pay card or a debit card. Unfortunately though, sometimes some types of expenses are harder to pay on a debit card. Rent would be one of those that's probably hard to pay on a debit card. So, and as it mentions here, so the Consumer Finance Protection Bureau says that employers have to offer at least one other option in addition to the pay card. So they cannot mandate that an employee has to receive their paycheck on a pay card. I actually had a friend whose son was working at a McDonald's up in North Iowa, Mason City, I think it was, and they only paid their employees with a pay card, and she called me up to ask about that because she thought that wasn't quite right. I'm like, yeah, that's not right. They have to offer it. They cannot mandate it. I don't quite know what ever happened with that or if they ever brought it up with them, but there are employers that will break those rules, and they'll break multiple types of payroll rules. Let's see. Final pay, so I kind of alluded to this earlier. There are some states will mandate that employees be paid their final paycheck within a set period of time. In Iowa, there's no requirement that the terminated employee be paid before the next regular payday. So they can just be paid on that next regular payday. There are some states of California and Minnesota, as they mentioned here, where the employee has to be paid on that day. So if you terminated, they've got to give you your last paycheck right then and there. So that means that the payroll department has to be ready to process that payroll and make the calculations for that final payroll. There is no mandate that employers pay for vacation time that's been accrued or for sick time that's been accrued, but there are some state laws here and there that do require payout of those amounts, but there's no federal law mandating that. All right. Let's see. Questions so far? I know this is kind of like the first chapter where we're just kind of going through stuff. We will get to some journal entries here. This part's kind of interesting, and maybe you're aware of this, maybe you're not aware of this. So unclaimed wages. Believe it or not, there are employees who receive a paycheck and then they never deposit the paycheck. They have it, or maybe they never received it. Maybe it came in the mail and they had moved, or something happens where they didn't receive it, but unclaimed wages. When there are unclaimed wages, those wages do not belong to the employer. They cannot revert to the property of the employer. So what happens is the employer, at least in Iowa, the employer has to make attempts and document those attempts to find the employee. So, and that is for, I think that's a period of 1 year in Iowa. It says there, most states will require 1 year. So they have to continue to make those attempts. If after 1 year they cannot locate the employee in order to make the payment, they do not get to keep that money. They have to send it to the state. The state has a fund where they keep those amounts, and then they make attempts to try and locate the individual. There is in Iowa, has anybody ever heard of this? Let me see if I can find it. There's a website. Yes. Iowa's great, what do they call it?
Iowa Great Iowa Treasure Hunt.
Yeah. Unclaimed property. So as I mentioned here, so they've returned $354 million to people that have been owed. Now this is the case not just for wages, but also for vendors. So if a company makes a payment to a vendor and that vendor never cashes the payment, they can't locate them, those funds do not revert to the property of the company that made the payment. It has to go to the state, where they will make attempts to locate the individual. So you can go on there and see if anybody owes you any money. There's a search for it. So you can search for unclaimed property if you have a business. So businesses that are owed money as well may be listed here, or individuals. And this is where those funds go after a year. He looks very happy to have all that money under his under his control. So that's the agency in Iowa that keeps those unclaimed wages. Now, in reality, I know that there are a lot of companies don't realize that money's not theirs, and then they'll just cancel out the check and put the funds back in their account, but that's not what they're supposed to do, because it's not their money, right? It belongs to the employee, or it belongs to the vendor that provided the service. It's hard to believe that there are people out there that have money and they don't know it. All right, any questions so far before we go into some details about the journal entries? All right. So like I said, there are 4 journal entries that we're going to be looking at here. The first 2 happen when we pay the employee. So that's the trigger. That's journal entry number 1. We record the wage expense of the employer and the liabilities for FICA taxes and federal income taxes withheld. Now, there could be other amounts withheld as well, but we're gonna keep it basic with mostly just these, the taxes that have been withheld. Second journal entry is to record the amount of payroll taxes that the employer is responsible for. So that would be the half of Social Security tax and half of the Medicare tax, as well as food tax and SUTA tax on the wages of those employees during that pay period. Okay, so all of that is recorded when the employee is paid. So as I mentioned here, employers must record both journal entries every time they issue any paycheck, even if they're cutting a check for 1 day's wages, or if they're cutting a check for 1 employee as well. So, how do we do this? All right. So here is our payroll register, right? Our abbreviated payroll register. We've got two employees, employee A, employee B. This would have, and this is just for that one pay period. We have our gross amount of wages before any taxes are taken out. Social Security, Medicare, federal income taxes, which we know how to calculate. We know how to calculate all these taxes now, right? So if you know what this amount is and you've got all the details about that employee, what they've chosen for their, what they put on their W-4, what they put on their Iowa return, although I know we didn't go into details on Iowa quite as much, but you should be able to calculate all of that, what these amounts would be. You know that Social Security is gonna be 6.2% of whatever they're paid. And this, again, this is only the amount that the employee is responsible for. That's our first journal entry. We've got our gross, and then all of the amounts that were withheld. Now in this case, they do have insurance included here that the employee is having withheld. And then their net paycheck. What this is gonna look like, the gross pay, so that's an expense, right? Or wage expense, or whatever we're gonna call it. You know, if maybe this is one particular department as well, so we're gonna call it wage expense purchasing department. You know, whatever we're gonna call that wage expense. That's gonna be our debit. So wage, right? Let's see if we can find it. And we're gonna take the total amount of our wage expense, $18.45. So we've got to sum all of those up. There's our debit. And that's the only debit that we have in this transaction, which means all of our credits need to equal $18.45, right? As our debits are $18.45, so our credits, DR. I don't know why it's abbreviated DR. There's no R in debit. All right, the rest of these, the amounts that are withheld, are going to be our credits. So, wage expense, so we have OASDI, HI, and these may be, they may call these something different on the next page, we'll see. Federal income taxes withheld, state income taxes withheld, and insurance. Then we also have our net paychecks, or actually, we're gonna credit cash here. We're gonna call it cash. That's our asset. So all of these other amounts, $114.39, $26.75, might not be lined up exactly right, $170 and $50. $191 for insurance. And then our cash amount that's actually going out, $1292.86. Now these are amounts that are gonna be payable, right? We've taken those out of the paycheck, but we're gonna have to pay them to the IRS in the case of the OASDI, Medicare, and federal income taxes withheld, and then to the state with regard to the state income taxes withheld. So this is gonna be a liability. This one, and this one as well. Normally called a payable, right? So OASDI, payable. Okay, HI, all of those as well. So here's what our journal entry looks like. It's like what we just put down here. So use the accounts that your book uses, the account names that your book uses. Like I said, each employer may have something different because they may have FICA taxes payable and then OASDI purchasing department, right? So they may want to divide, may want to subdivide those account categories up. So we've got our expense, debit, all of our liabilities, And then we're also crediting our cash because that's cash going out. We're paying that cash. This is our first journal entry. So it's pretty simple to put together because we just take, this is our debit, gross. All of the rest of these are our credits. Questions about that first journal entry? Okay. That's the first one. Okay. Now, let's look at the second journal entry. So this would be the second side of the payroll register, the amounts that the employer is responsible for over here, and that's our second journal entry. Again, we're gonna make this entry when we actually pay the employee. So we've got our salaries listed here, our gross amounts, and we've calculated how much of those wages are subject to FUTA taxes. So you can see here, we can extrapolate some information about these employees from the information that's on here, right? We know that, so $615 of that $845 is subject to FUTA taxes. So during this pay period, they reached that $7,000 point, right? Because not all of their wages are subject to FUTA taxes. So this is obviously not the first payroll during the year. For employee A, none of their wages are subject to FUTA tax, so they've already, in prior periods, they already reached that $7,000 point, right? Same thing with SUTA taxes. So during this pay period, employee A must have reached whatever the threshold is for the state that they're in. We don't know from this information, but they reached that wage base for state purposes, but employee B has not yet reached that threshold or that base amount for SUTA wages. None of these employees have reached the $147,000 because all of their wages are subject to Social Security tax, right? We don't have any additional Medicare. Well, if we had additional Medicare tax, then of course we would have some of our, probably all of our OSD or Social Security wages would not be subject to Social Security tax. So this particular one, the debit is to payroll tax expense, and it's going to be the total amount of the taxes that are paid. Okay, so payroll tax, and so you're going to have to do some math on this one. And it's important to indicate that it's payroll tax, not just tax, because the employer probably pays other types of tax as well. They may pay income tax, they may pay sales tax, they may pay excise tax, property tax, that sort of thing. You have to indicate what the type of tax is. That's important. So our payroll tax expense is going to be the total of all of those amounts. So we gotta get our calculator out. So, whoops. $190.89. So you can imagine our credits are going to be these separate types of separate categories of liabilities. So we could have FUTA tax payable, SUTA tax payable, OASDI payable. Remember, this is just our general journal at this point. We haven't yet gotten to the general ledger, and then we've got our HI payable. And each of these is just the amounts that are payable, so. And of course, it's good to add all of those up, make sure that we balance on both sides. And that's our journal entry. So this is the second one again. That's gonna happen when we actually pay the employee. And all that information is gonna come from the payroll register. So it's gonna be the totals of all of those amounts. And we make those every time we pay an employee, or all employees. Every time we run a payroll. Questions about these journal entries? Does it fit with if you're taking principles or intro to accounting right now? Or I guess we don't have intro to accounting. Fundamentals of bookkeeping is what we have now. Okay. Excellent. Let's see. Let's do this one just for fun. Cronus Chemicals is liable for a FUTA tax of $1,200. What is the journal entry to record the FUTA taxes payable? So these are FUTA taxes. So here's we can reference this one and see which matches. So $1,200, and this is to record the payable amount, not the amount that they've paid yet. They haven't paid it yet, but the amount that they have of liability that they have accrued. So what's our debit gonna be? We can reference this to look at it. So we've got the FUTA taxes, it's essentially just going to be this part here, right? Except it's not going to be $369 and $190.89. It'll be for the $1,200. Right. So we are going to debit payroll taxes. Here we've got payroll tax expense. I think it's nice to put expense there. I think your book doesn't always put expense. I think it's good to put down what type of account it is. For me, it makes more sense. It helps me to distinguish it from, oh, that could be a payable, that could be a liability account. So we're gonna debit payroll taxes, and we're gonna credit FUTA taxes payable. So that's our liability account is the FUTA taxes payable. Got our expense on the debit side, our liability account on the credit side. Same thing if we were, let's say we've got it's just FUTA taxes. If we're just making an entry for FUTA taxes, then it's gonna be whatever so if it's $1,200, we'll have payroll tax expense of $1,200, FUTA taxes payable $1,200. We haven't paid it yet, but we've accrued that liability. Excuse me. Thank you. So again, this is journal entry number 2. This is probably a pretty good place to stop before we post it to our ledger accounts. So again, what we've done here is posted to the general journal. We've made our journal entries. Next step in the process is to then transfer that information into the ledger accounts, the general ledger. And each of these accounts is gonna have their own sub-account. Those are the T accounts that you've worked with in principles and your intro classes. You remember the T accounts? Everybody remember those? Okay, so this is where we're gonna then transfer all that information into the T accounts. From there, we can then put it into the financial statements ultimately, okay? So that's where we'll start out. Let's see, so we've got, today is Thursday, right? So Tuesday, again, I'll be here. If you wanna come in and use that time to work on stuff, ask questions, I'm not gonna lecture, but if you have anything, and I'm not gonna take attendance, so if you don't wanna come, you don't have to come, okay? But I will be here. I think I'm gonna give you a Thanksgiving gift too, and not have that homework due on Thanksgiving night, because that's I was thinking about that as I was driving. I'm like, that's a little mean. So if you've already done it, good for you. You're ahead of schedule. But I will change that probably to Sunday night. I'm going to give you the weekend while you're recovering from your Thanksgiving comas. Okay. All right. Have a great weekend. Maybe I'll see you on Tuesday. Maybe not.